If you own a US LLC and you're about to move abroad, the next 6 months can quietly cost you tens of thousands of dollars in mistakes that are almost completely preventable. I see this every single month. Someone moves to Lisbon, Mexico City, Bangkok with their US LLC running in the background, assumes nothing changes, and finds out 2 years later that almost everything changed the day they boarded the plane. I'm Vincenzo. I left a Wall Street career 15 years ago to live abroad, and I've been running an international tax firm ever since, helping Americans make this exact move. 5 mistakes. Every one of them I've seen cost clients real money. Mistake number 1, not understanding what kind of income your LLC actually produces. This sounds basic. It's not. The IRS treats 3 types of income very differently, and how your LLC income gets classified determines almost everything about your tax bill abroad. First, there's active income. Active income is money that you work for. Consulting fees, agency revenue, e-commerce profit, where you're running the business. This is what most LLCs produce. Second, there's passive income. Passive income is the money that comes in without active work. Rental property income, royalties, certain investment returns. Then 3, there's portfolio income. Portfolio income is capital gains, dividend, interest, things from investing. Now here's why it matters the second you move abroad. The foreign earned income exclusion, that $130,000 tax break that we talk about all the time, only applies to active earned income. So if your LLC produces rental income, the FAE does not help you. So I've had clients move abroad assuming their entire rental portfolio income will qualify for the FEIE. It doesn't. They moved expecting one tax bill and got a completely different one. However, I will give you a hot tip. If you are actively managing the real estate portfolio, you can pay yourself from that. And as long as it's arm's length, which means that it's aligned with what the industry charges, then you can pay yourself a salary and get that excluded under the FEIE. So generally, we see clients taking a management fee of roughly 10 to 15% of the rent roll. And of course, this depends on the region and what local comps could support, but you still can do it. So do this today. Pull up your last tax return. Look at your Schedule C or your K-1. What kind of income does your LLC actually generate? If you don't know whether it's active or passive, that's the answer about whether you need a real conversation before you move. Now, even if your income type is clear, there's one mistake that's bigger than all of this combined, and it's happening in your wallet right now without you even thinking about it. That's mistake 2. Mistake 2 is moving abroad without cutting your state tax ties. And this is the single most expensive mistake I see, and it's the most preventable. And again, it doesn't matter whether your income is active or passive. If you are paying state tax after you move abroad, you're losing money. Now, states like California, New York, Massachusetts, and Virginia are probably the most aggressive states about claiming that you still live there after you moved abroad. However, whatever home state you're living in before you move, they can try to pull you into their tax net. So if your LLC is registered in your home state, if you still have a driver's license there, voter registration, a house, apartment, a car still registered, even a mailing address that you're receiving documents, especially tax documents, brokerage statements, etc., the state can argue that you never actually left. And what's the result? You pay state income tax for years after you move. I've seen clients pay state income tax in California for 4 years after moving to Portugal, just because nobody told them how to cut ties properly. Now, California's top rate is over 13%. New York City residents pay state plus city. So on a $200,000 income, that's roughly 20 to 30 grand a year that you shouldn't be paying. Now do this today. Check what state issued your driver's license. Check what state your LLC is registered in. Check where you're registered to vote. If out of these 3 are still pointing to that high tax state, then that's your first phone call before you book the flight. And it's an easy fix. You could domesticate your LLC to a state like Wyoming. You can get a mailing service to change your license and your voter registration. It's all doable. But this is the thing. Documentation is everything. So save proof of your visa, your local doctor's bill, your lease agreement, your utility bills from your new home country. I mean, I've even had clients take pictures of the U-Haul truck with their belongings inside, along with the local paper that shows the date that they moved. No joke. I mean, this is something really important to have this documentation in case California or any state comes knocking once you already moved. Now, once your tax residency is sorted, you have another problem coming. And this one shows up in your business bank account about 6 months after you land. And that's mistake 3. Assuming that your US business banking will keep working the way it always has. The day you update your address with a foreign country, things start happening quietly in the background. US banks have compliance programs that flag account holders living abroad. Some banks tolerate it, but some don't. Really, most don't. And some don't even tell you that they don't until your account is suddenly under review. The bigger problem is the payment side. Stripe, Intuit, PayPal, most US payment processors are built around US-based account holders. They can flag, restrict, or even close accounts when they realize the operator's abroad. We've had clients lose months of business because their Stripe got frozen and they had no warning. So here's the part most people don't even realize. The LLC itself doesn't care where you live. You could keep operating US LLC from Lisbon, Bangkok, or Mexico City, wherever, forever. The problem is the banking infrastructure, which assumes that you're sitting in Ohio still. Do this today. Call your business bank. Ask them directly, do you allow account holders to operate this account while living abroad full time? If the answer is anything other than a clear yes, you have a banking project to handle before you move. Now, we generally work with places like Mercury, Relay, and a few others that tend to be more expat friendly. Most traditional banks are. And I can even speak from experience because when I moved, my Chase account was closed for no other reason. Banking is the visible piece, but there's another piece happening on paper that's invisible until tax season. And that's where most of the real damage gets done. Mistake 4, assuming your tax filing will look the same after you move. Now, when you live in the US, your LLC tax return is straightforward. A single member LLC files Schedule C, partnership files a 1065 with K1s. You report your income, you take your deductions, done. Now, the day you move abroad, new forms get triggered. The ones that most CPAs miss are the ones that hurt. First is the FBAR, Foreign Bank Account Report. And if your total foreign account balances cross $10,000 at any point in time during the year, you must file. Now, penalties for that start at $10,000 per account per year. Form 8938 is the statement of specified foreign financial aspects. It's a different threshold, different rules, and it's actually a separate filing that you file with your tax return. Form 5471 for if you own a foreign corporation, Form 8865 if you're in a foreign partnership, Form 2555 to actually claim the FIE. I've reviewed hundreds of returns where a domestic CPA filed the exact same return after the client moved abroad. Same Schedule C, same deductions, 0 new forms. Client thinks they're fine, and they're not. They're just not getting caught yet. So do this today. If your current CPA is the same one who filed for you when you lived in the US, ask them one question. What new international forms apply to me now that I've moved abroad? If the answer is what new forms or a long pause, you have your answer by your CPA. Which brings us to the last mistake. And this is the one where everything you learned about how to pay yourself in the US actually flips on you abroad. Mistake 5, not having a plan for how you'll pay yourself after the move. When you operate a US LLC domestically, the conventional wisdom is clear. Single member LLC, take owner's draws. Profitable LLC, consider upgrading to the S Corp to save on self-employment tax. Now that math does not translate abroad. Here's the short version. The S Corp move that saves a domestic owner thousands of dollars in self-employment tax can quietly prevent an expat from maximizing the FEIE. Why? Because S Corp profit distributions don't count as earned income. They don't qualify for the $130,000 FEIE. So the savings can cost you tens of thousands of dollars in lost FEIE benefits that you are already getting just by leaving the LLC alone. We see this constantly. Clients move abroad, their domestic CPA pushes them to elect the S Corp, and they take a low salary because it saved their domestic clients money. What actually happens is they lose the FEI benefits on the distributions. So they pay themselves a low salary, they save 15% on the self-employment tax, but then they pay 24% tax rate on that same income because it wasn't excluded under the FEI. I won't get into the other side of the equation, which is the question about how an S Corp might be taxed locally, because that really depends on the country in which you're living. But that's another consideration you should also think about. So do this today. If your business profit is under $168,000 a year and you're moving abroad full time, The S Corp election is usually the wrong move. So if your CPA is pushing one, ask them, have you modeled the FEI impact? If the answer is what? That's the answer about that CPA. Now, here's the part nobody talks about. Every one of these mistakes is preventable if you handle them before you move. Every one of them gets harder and more expensive to fix after you've already left. The move itself is the most expensive tax event of your life if you handle it wrong. It's also one of the most rewarding ones if you handle it right. The difference is planning, and planning has to happen before the plane takes off, not after. So these are the 5 mistakes: income type, state ties, banking, filings, and your pay yourself plan. If you already passed the move and realize some of this applies to you, the most important next step is figuring out exactly how to pay yourself the right way from your US LLC now that you're abroad. The next video on the screen walks you through exactly that, including the one decision that determines whether your FEIE survives the move or quietly disappears. Watch that one next. And if you're still in the planning phase, the link below will get you on the call with our team. Getting this right before the move is one of the cheapest pieces of insurance you'll ever buy. Thank you.